Welcome back to Bitcoin and Beyond. Today we have Jagdeep Sindhu from Rollux and Syscoin to talk about the Bitcoin Superchain. Welcome in, sir.
Thanks for having me again. Glad to be here.
Awesome. Look forward to having this presentation and learning more about Rollux for sure. So can jump right in as soon as you're ready.
Sure. Yeah, I think we're talking about scaling Bitcoin and doing it in the most responsible way we think possible. So Rollux is a layer 2 that we've been working on. It's sort of a full stack integration on top of Bitcoin. We've been doing this for about 10 years, and we slowly have evolved our design. And so we think it takes that long for teams to realize, where the pain points are and what the problems of scaling are in general in blockchain. Not even talking about Bitcoin, just scaling in general, how to scale, and then applying those concepts, and as well as the vision of where potentially we could be going in the future. For example, not scaling on the layer 1 and scaling through layer 2s. I know a lot of people are hitting back at that and saying, look, Solana is doing good, but we think in the long term there are really good reasons to separate the scaling and break it up into pieces. And doing that through Bitcoin is also a critical thing, because Bitcoin itself is not Turing complete, but we do want to add the utility to the Bitcoin layer, given that it's sort of the super vault store value, and definitely has a first mover advantage and regulatory clarity across the industry. So, figuring out how to add more utility to that is definitely low hanging fruit, and almost seems to be, the biggest thing that's on the table right now for the industry. And so Rollux, we're classifying it as sort of a Bitcoin superchain. It's a home for Bitcoin in a way that does not interfere with Bitcoin tokenomics or consensus. We try to remove the MEV cost attack vectors from Bitcoin itself, but still give the option for Bitcoiners to have the best possible experience scaling without actually embedding things right into Bitcoin, which would actually create MEV attack vectors. So Rollux is right now optimistic will convert into ZK fairly soon. A system that's settling on a sidechain that starts with merged mining and then applies data availability in a full modular stack to scale up. We start to see these main blockchains looking sort of like digital smart cities, where you will have EVMs, Turing complete EVMs, but you also have Bitcoin as the super vault, and the EVMs actually allow you to build anything. And so the way we think about them is the base will be sort of like your core city, and then the suburbs start to look like the fractal layers on top. Like suburbs can be roll-ups, or suburbs can be very big dApps in the case of Solana. And they're sort of looking like smart cities, or how cities sort of formed organically. And the challenge is, how can we bridge that liquidity, especially from Bitcoin? How can we bring that BTC over in the safest way possible without creating new trust assumptions? And this has sort of been the challenge for many years, what we've been trying to solve. And we have a white paper coming out on creating a framework for the industry and how we solve these problems in the safest way. We started in 2009 with BTC, and then we created our first core release, which is compatible with Bitcoin, 95% of Bitcoin, pretty much without much changes. We were one of the first 5 merge mine coins. Merge mining is this interesting concept that lets you borrow the security of Bitcoin and apply it to sidechains. However, doing so, just vanilla merge mining, it just lets you borrow the security, but it's not transfer the security. And that's critical, because there is no attribution of fault. And also Bitcoin miners don't lose any of their blocker words if they are faking or attacking the sidechain. So for example, if Syscoin is being merge mined with Bitcoin, and there was is just vanilla merge mining, then Bitcoin miners can effectively create forks or do whatever they want on Sys in terms of faking the history or creating faked history, as long as it follows the difficulty of Syscoin, they don't lose any of their Bitcoin blocker words doing so. So this is a big challenge that needed to be solved, and we worked on that. In the context of scaling Bitcoin, this is particularly important because when you talk about scaling Bitcoin through sidechains or any Bitcoin system that requires sort of an EVM or account-based model, or even creating a ZK system where the Bitcoin is going to be living in the ZK system, you start to talk about bridges and you start to talk about security of that system, especially when you want to move that Bitcoin back. So when you peg out the Bitcoin, then it becomes critical that your security of the side system is as secure as possible, as close as or exceeding the Bitcoin security if possible. So that's the challenge. And if you can't provide that, then again, the Bitcoin miner or whatever consensus system is running on the side can fake your chain history and therefore steal the Bitcoin. So figuring out merge mining and sidechain security is critical to be able to create a safety net for that Bitcoin not to be able to be stolen once it does bridge over. Bridging into the sidechain is not an issue. It's always coming back as the issue. In 2015, we looked at smart contracts and created the first version of on-chain smart contracts, or identities, marketplace, certificates, which are sort of like NFTs. And we focused on sort of the 99% of the use cases to hard code them. They weren't really, it's not a virtual machine that we created, but it was more just like coding up the initial use cases. And we found even doing that we hit roadblocks. Even though we created a scalable solution there, we still thought it would not scale enough for what we needed to do to hit mass adoption. And so around 2016, we saw the big block debate on Bitcoin Talk, and we realized that layer ones, at least, are core systems. They're not transaction processors. So we saw the first sort of sparks of modularity there, modular blockchain back in 2016. And so we've been building towards that since then. With ZK and all that, we didn't really know how to do it properly until around 2021, which we'll cover here. In 2018, we realized that we do need some sort of system where, and even ETH Foundation has been saying this forever since they looked at this around the same time, was paid full nodes. You need to increase your Nakamoto coefficient by having nodes run all the time. You can't really make it altruistic that you assume that someone's going to be running a full node. If you pay people to run them through your block subsidy, you're subsidizing the cost over all the users, but you get that increased utility because the resilience of your network benefits. So we created these Sentry nodes, and there's about 3,000 of them. So about 40% of the supply is locked up in them. And we researched ways we can scale up the blockchain using these. Like Ethereum is using validators, and then having the validators do DA and ordering of the virtual machine. In our mind, we looked at, we view Bitcoin as sort of this very secure system that does not need special nodes. And so Sentry nodes for us was not to try to create new consensus, but really just to increase the resilience of the existing network stack that we had. We did look at trusted executions like Intel SGX or doing smart contracts with hardware in a secure way, but that didn't really. We felt that the manufacturers were, a bottleneck there. So Sentry nodes essentially allowed us to look at very specific problems and solve them in a unique way without sacrificing the Bitcoin sort of methodology where every node verifies everything. Because if you don't have every node verify everything, you do have a subjectivity problem like you have in proof of stake, where you have to trust someone else to give you the state, and it has to be correct for you to be trust the state of the system. So you have to reach out to some block explorer or reach out to some other node and say, okay, what is the state of the system? Okay, I trust it, it's correct. And that is the trust we're trying to remove, especially during Black Swan events. You can't trust anyone else but yourself when you're syncing up to these systems. And so we try to stay within that paradigm even when running Sentry nodes or creating Sentry nodes. But we did realize that there was a very big problem that we explained with merge mining. Particularly, the Bitcoin miners can screw around with the sidechain as much as they want, and that's actually called selfish mining. And we needed to resolve selfish mining to be able to create security within the sidechain. And again, we didn't know the story of how it affects Bitcoin security and all that, or like client security or Bitcoin bridging until way later. We did know that we wanted to solve for selfish mining. And the chain locks that we created essentially lock the blockchain every fifth block back and allow Bitcoin miners to be asynchronous and still, fork each other within that period. But after 5 blocks, the Sentry nodes essentially lock the chain, and they force the Bitcoin miners to be honest. So if the Bitcoin miner is creating a fake chain on the side chain, then they have to restart every 5 blocks. There's only a race to create five block forks there.
Did you say a fake chain within the side chain?
Mm-hmm. Like not really a fake chain as in like you can do double spends and stuff, but more as in like you are MEVing or you're reorging, or you are creating a long really long attack, long range attack on the side chain. For example, creating a history that's rolling back the chain 200 blocks. And it's going to be really important when I explain the Bitcoin problem. For now, it doesn't really matter too much, because yeah, you roll back Syscoin chain. It doesn't affect Bitcoin chain, but what are you actually gaining from that? You're not gaining much until the sidechain has a lot of volume, a lot of DeFi or something that's going to give them money. But when applied to Bitcoin, there is a very specific problem that you have to solve with finality. And if you don't solve for selfish mining, your sidechain system is sort of hopelessly insecure. So we'll cover that. But it's
Gotcha.
not, you're not
Makes sense.
faking, you're not creating a totally fake chain that doesn't follow the rules. It still has to follow the rules. It's just you're creating a fake history, and it's a big challenge. We didn't know that challenge was so important when we solved for this, but we realized later that it does solve for that. And we just wanted to avoid the Bitcoin miners from screwing around with our sidechain here. Even though we work with the biggest pools, it's just we don't know the incentives, and we wanted to technically resolve issues so that users, if our sidechain does take off, the users are secure, knowing that systems don't roll back. Like for example, Binance, people wouldn't do double spends with Binance and deposit and then sell and withdraw and then roll back the whole chain. That's something we wanted to avoid. We did a dual chain infrastructure in 2021, so we did the EVM. We do believe that EVM is sort of the, I know you guys are looking at parallel virtual machines and stuff, but at the base, the decentralized, very slow, safe virtual machine that needs to be provable and safe, as safe as possible. We thought the EVM is that. All of the custom virtual machines that may offer parallelization or speed, I think we can build those on top on the secondary layers. And so now it's looking like proof of work Bitcoin, UTXO sidechain, and then EVM on top. And those UTXO sidechain and EVM are sort of coupled together every block. And then this is sort of what chain locks are looking like. You basically lock the 5th block back, and it's a super secure system that creates finality. And incidentally, once you create finality, you can solve for DA, right? Because you can't have DA unless you have finality in your system. Because if you're removing data from your system, the blockchain can't roll back from that point. Otherwise, you can't replay the chain. If data is missing and you're trying to reproduce the blocks, the system just halts, right? So once you have finality, you could agree on when the data should be removed from the finality point. And that's where Bitcoin DA was born. We effectively added DA to our base. And we called it Bitcoin DA because it's the Bitcoin miners are securing the system through the merge mining protocol. And that DA is used to scale up everything beyond, just like sort of like Celestia, but also like EIP 4844, where there's rollups. And Rollux is the first example of something that consumes that DA. The finality creates a very secure, incentivized, resilient network. And then the DA creates scale that lets us scale up the rollup. And it's a very specific implementation of DA. It's not like the ones you're hearing about out there, like Avail, Celestia, even 4844, all based on KZG commitments. Those are all sampling based. We actually went to a more secure, stable, non-trusted setup thing that we called hash-based DA, which basically just has every node verify the data and hash it and check that the hash matches the commitment, and then it's available in the system. That sort of solution will offer less bandwidth, but it'll be super duper secure. Like there is no chance that some nodes have the data and some nodes don't. All of the nodes have to be in consensus that they see all of the data. So when applying to Bitcoin, again, very it's obvious that a Bitcoin person would prefer that sort of solution.
Yeah, and like, how does that? I don't know if you have another slide that's going to show, but I'm curious to see how that works. Or like maybe you could just like briefly explain like a bit more. Like, okay, like is it dependent on the hash power, that like the hash rate, or just kind of like what is the mechanism that, that allows the data availability layer to be extremely secure?
Yeah, it's just using a Keccak hash, and the security is again taken from the merge mining concept, where the side chain, where the DA, you can't put the DA on Bitcoin, right? Because Bitcoin doesn't have this special concept. Even if you have, some people are saying you could do SegWit blobs in Bitcoin, especially with Opcat or something, you can have prunability of data in Bitcoin, but you need finality. If you don't have finality, you're going to have to throw the data into Bitcoin and it'll be in Bitcoin forever. Yeah, it's going to be pruned from your node, but you're going to have to download all that data every time you sync up. So it's not really solving the challenge. And we put the DA, a special DA solution, into our sidechain, and the Bitcoin miners are merge mining it. The finality of that sidechain ensures that the Bitcoin miners have to be honest, or their proof of work is slashed if they try to create a long range attack beyond the finality. And that creates the transferability of the security of Bitcoin into the sidechain. And so anything you do on the sidechain is now, securing yourselves to that Bitcoin system, which is basically shared by all the miners. So the hash rate is driven by the miners, right? And that's the security we are transferring into our system. And so the security is based on the mining network of Bitcoin, but the solution is dependent on just a hash, which is there's no trusted setup and it's quantum secure, and it scales a little bit less, but it scales just enough for most of the majority of the secure use cases to set up like a base layer. So for example, like optimistic rollups, you'd be able to do 6,000 to 7,000 transactions a second before the fee market starts to drive up the cost of the gas market. We think that's adequate for a base, and then you'd have your other supplementary sampling based DAs that scale up with the number of nodes, like Eigen DA, for example, could come in with Bitcoin as the backing collateral, and you have a scalable solution that trades off a little bit security. It's not as secure as the one at the base that's enshrined. Not as secure, but it's a little bit more scalable, 10 megabytes a second. So users can have the option to decide, I want, if I'm doing GameFi or I'm doing some sort of trading on a DEX, order book DEX or something like that, then I could, do my trades and settle on the very fast DA, very low cost, because, if anything happens, I just lose my trades for that hour or for that day. And then at the end of the day, I settle my balances back into the very secure system, the enshrined DA. So even within modularity, we would be breaking up DA layers across the system to create a more holistic approach rather than one DA to solve them all, which doesn't make sense to us. So I
And
hope
in
that
this
answers.
example, um, the need for multiple is because of the different constructions of basically uh, like a Syscoin and Bitcoin, um, in terms of how of like the different chain structures. And you could also like could Rollux also settle to like Ethereum and other chains and L1s and be implemented, or is it pretty much just settling to Bitcoin and Syscoin?
Yeah, no, if like I was saying, you have that Celestia story. So once you get like we call it a ZKDA, which is the light client, that would allow us to essentially offer settlement to other chains as well. So, and I'll talk about that. That Rolex is sort of this transfer hub that it lets you borrow that security and transfer it to other chains as well. Like how we're transferring it from Bitcoin, we could transfer that security from our sidechain into even Ethereum or Avalanche or some of the other layer ones. So definitely we could package the whole system up and show that you can use the DA and have settlement across other chains. So they can take advantage of, this hardcore secure version of the enshrined DA, or if they like the Bitcoin backed sampling system that has the Bitcoin collateral securing it, then they can opt in for the eigen DA as well. So that's sort of what we're basically saying. Look, our system is secured through Bitcoin. So if you like that, if you like our crypto economic systems or the security of the system backed by Bitcoin, then the very same story you're using it for other DA layers like Celestia, um, that same sort of thing can apply to us, but with Bitcoin as a security blanket behind it. So that's what we call ZKDA. So we're working on a ZK-based light client that respects our finality as well as the proof of work longest chain system that it would guarantee in a recursive proof. Okay, so we get a little bit into proof of work versus proof of stake. So I think proof of stake offers more security because of the short-term security, at least because of the attribution. Like you can slash somebody if they're found wrong, and eigen AVS services are examples that take the shared accounting, shared security of Ethereum or the base gas token, and then apply that to specific concepts with slashing. It's really interesting that slashing, you end up having weak subjectivity. So you do have some subjectivity in the system. It's weaker than just having POS itself. I think POS itself is not very good, but with slashing, it's good. But proof of work offers something different. It's more about the black swan prevention or the anti-fragility, as well as not having any subjectivity. So that means there's no human governance in that solution. So if you philosophically think that the system breaks and Bitcoin gets sold off because there's a huge reorg because someone's trying to attack it, and Bitcoin sells off to $1,000, right? If you think that it cannot recover from that, then philosophically, you might be more in the proof of stake camp. But technically, there's nothing stopping it from recovering because there's no human intervention needed from that solution. And a black swan has occurred. It will always occur. Yes, it takes down maybe the market price and the confidence, but technically the system can recover. And that's the difference between proof of work and proof of stake. And proof of stake, that same situation happens. It requires human governance or subjectivity to kick in and resolve. It doesn't resolve itself. That black swan will happen, and it will require a hard fork and probably slashing of the collateral of the bad actors. So if you think that humans can get together and resolve these situations, proof of stake, you might be more in that camp. So the philosophy is black swan prevention, technical resolution is better in proof of work, but you don't have the slashing considerations. So you have to rely on the fact that it has to slowly build itself up, back up. And then, but in our solution, we thought, okay, why can't you sort of apply the best of both concepts without giving up the black swan capabilities, or if we could slash Bitcoin miners somehow. And that's what we did with finality, right? We effectively are able to attribute dishonest Bitcoin miners to create honest short-term behavior, because they cannot create a fake history in by mining Syscoin when you're merge mining, because they have to start over every time there's a finality event. If they're creating a fake chain, they effectively have to take over your whole validator set to try to fake that system. So the costs start to go up, and this matters in the context of scaling Bitcoin, which I'll start to cover now. But the concept we created is sort of both, right? There's Bitcoin proof of work behind it, but then there is finality that starts to sort of proof of work slash Bitcoin miners. So we do see the benefits of both, and we try to combine both in a way that doesn't lose ourselves from the Bitcoin security system, and it doesn't resolve itself down to just proof of stake. And then Rollux is sort of that, and then you add in the fractal superchain concept on top with all of the additional things like eigen cryptoeconomic solutions. Probably there's app chains with Bitcoin, and there's ZKDA for selling the settlement to other chains, like you were asking about Ethereum or other chains that want to borrow that security. Okay, and so this is why it starts to matter, because when you're talking about scaling Bitcoin, you end up having something called sidechains, and when you do sidechains, you have light clients. Now, not all solutions in Bitcoin need sidechains, right? Like Babylon, for example, doesn't really need a sidechain. You take Bitcoin, you wrap it into Taproot, and then you have an equivocation of a Schnorr signature that if you try to sign 2 blocks in your proof of stake system, and you are trying to fork that chain, then you lose your Bitcoin collateral. And there's no notion of me moving Bitcoin from Bitcoin into the Babylon system. That would be a sidechain if you try to do that. That would be a bridge. But Babylon itself isn't technically a sidechain. However, you start to lose things like DA, and again, moving that Bitcoin over into that system. If it's just a proof of stake system and you just have a bunch of other assets, it doesn't include Bitcoin, then you don't have the ability for you to create cryptoeconomic solutions like EigenDA or bridge services that are secured with Bitcoin, or DeFi that's secured with Bitcoin. So for us, it's a non-starter. You would start with a sidechain, right? You start with a sidechain, try to secure it as best as possible. When you're talking about sidechains, then light clients start to matter. And light clients are specifically when you try to move the Bitcoin back over from your side system back to Bitcoin, then it relies on the light client of your side system. For example, if you even look at some proof systems like Citria that try to build into Bitcoin, they are settling in Bitcoin using Bitcoin as DA, and everything is supposed to be native. But even in those solutions, they rely on Bitcoin as the light client, because the Bitcoin is actually an IOU Bitcoin you're creating inside the ZK system, so you can use an EVM. And you're scaling up using an EVM, and you're doing DeFi or whatnot. But when you're moving that Bitcoin back over to BTC, you do have to take a proof of your side system and show that, okay, there's 500 blocks of this side system, and the BTC has been burnt, and you are now minting it back on. You're moving it back out of the Taproot address of Bitcoin main chain. And if you can fake that 500 blocks, then you can steal that BTC. Like if you take a look at BitVM and then the challenge system within BitVM, typically an operator can just try to take the Bitcoin, right? And then he has to wait a few, maybe say 7 days for someone to try to challenge it. So if there's 10,000 Bitcoin in there, I can say, okay, well, let me just move the 10,000 Bitcoin to my own address. And he can try to do that. However, if he tries, someone can challenge him, and they will likely win a bounty. The operator will lose money. If you, in order to challenge, you just have to show, look, that there's nothing that's been burnt on the side system. Like, why is he trying to take the Bitcoin where there's no proof? So if you're able to prove that nothing has happened, then you are able to stop the attack. But if the attacker, the operator, shows no, there is a system, there is a chain that's 500 blocks, it has more work, or it has a longer history, then he wins. And if you're able to attack the light client by showing this proof, then you can effectively steal that Bitcoin. And so light client security is this big thing that is really the critical underpinning of all of the Bitcoin solutions that take the Bitcoin and move it into another solution. If you do Babylon, you don't need it. But again, then you don't have any of the solutioning around using Bitcoin in that system. Anytime you have Bitcoin in another system, you end up having light client security. So you have Bitcoin light client security, which is something like Citria, and you have sidechain light clients like all of the existing Bitcoin L2s that create proof of stake sidechains. They are not tied to Bitcoin security in any way. They're effectively just validator set. And if you can take over the validator set, whatever the cost is there, you can effectively fake the light clients. Our paper is focusing a lot on the light clients. And in ours, you effectively have the merge mining security of Bitcoin. You do have to 51% Bitcoin in order to fake an attack using merge mining. Although you can repurpose the hash from Bitcoin, you do have to sort of do this attack. And then also on top, the Sentry nodes, which are they require a super majority of the coins to create the finality. So if you were to try to attack our system, you would have to first take over the Sentry nodes, and then you have to go attack Bitcoin. And there's specifically something in there that makes it very interesting, in that because of you have to do this first and then this, you actually have the capability of detecting that attack if you know that the Syscoin chain, the tokens are being accumulated or purchased in the market, and then 66% of these new validators are being started, and all of the previous validators are leaving or gone, they sold off, and new validators are starting. You can see this happening in the network. You could effectively just move your Bitcoin out. You could just withdraw your Bitcoin if you're concerned about that from the bridge. And before the Syscoin side is taken over, you can move it out, and the Bitcoin attack doesn't start to happen. The merge mining attack doesn't start to happen. So this is the only solution we've seen that has a preventative measure from an attack. Every other solution, once the attacker commits, he's going to attack the system, and there's no way for you to get ahead of the attack. There's no way for you to say, okay, I've detected something bad happening. How can I move my Bitcoin out? By the time you realize that, the attack is already happening, and it's already going to happen, and you're going to lose your money if he ends up following through with the attack. In ours, you'd be able to say, look, something's happening. I can move my Bitcoin out before the Bitcoin side is hacked, the merge mining concept. So this is
quick question on that previous slide. On the last line, you have Bitcoin plus Syscoin plus Bitcoin cryptographic security. Could you quickly just reiterate the difference between like the previous lines where we have Bitcoin security, and then the difference between Bitcoin security and Bitcoin cryptographic security?
It's crypto economics, a typo, but what that is saying is there's once you do a side chain, you could bring your Bitcoin into the secondary system. Then you can launch things like EigenDA or other secured solutions that are using Bitcoin as collateral. Like, for example, if you do have an AVS service that's slashing Bitcoin but creating a BitVM bridge operator list that's decentralized, then you've effectively decentralized BitVM using trust minimization and using Bitcoiners that want to stake their capital to become an operator, and they get slashed if they're not live or they're not if they're not actually operating. But they do earn rewards from every bridge transaction that starts to happen. So that's just an example of using the system to recursively create solutions back to the security of the bridge or something related to Bitcoin. In that solution, you're actually creating a decentralized BitVM solution, but you can also use it for DA, or maybe using algo stable to create money out of BTC and spending that, and then having insurance, or you have the ability to do fast transactions, so you can spend that money at the supermarket, and the merchant can rely on you because they have insurance backing that. So there's different solutions you can create once you have the capital reserve to be able to crypto economically secure those systems.
Okay.
So the crypto economic solutions, you typically involve, like, if I have $1 million of value flowing through in a day or a week, and that's your that's the slashing conditions are usually have to wait for like a week, or there's a week worth of value, then that's how much capital needs to be tied up in the system or slashable for you to be able to create safety. So if there's like $1 million being used over the bridge every week, and you have the ability to slash, and the fraud proof period is say 1 week, then you need to have at least $1 million in the bridge backing it for you to say that it's safe, or someone has purchased the insurance for $1 million. So that's how the crypto economics solution would work. Whereas in our solutions, the one we're talking about at least, it's slightly crypto economic, but it's a dual model, and so you do have the ability for you to front run no matter how much is in the bridge. Even if there's $1 billion, there's going to be incentive, but the equilibrium points towards honest behavior, because if any one person could detect that and sound the alarm, and everyone can move out, there's nothing stopping everyone to move out, and basically the attacker loses however much money he's trying to spend, $500 million or $400 million. So if he was hoping to make $600 million profit, that profit really goes to zero if any one person detects and then people react to it. This is kind of what it's looking like today, right? There's a MPC threshold signature or something like that, and there's a lock and mint with Bitcoin moving to other chains. It's red, like I showed, like here, the sidechain security. It's not very secure. You start to get into light clients and watchers and people watching for invalid transactions or blockchains rolling back and then sounding some sort of alarm, or not allowing big transactions to go through, or waiting for a longer period, like what Thorchain was trying to do. And in the end, you always end up having some sort of 51% security in the system. You always end up having some light client security, is what Vitalik is saying here. Basically, your 51% attack is the critical thing. If you can take over the side system, then you've taken over the bridge. And if there's a lot of money in the bridge, you could get around that. And Tolly is sort of coming back after a couple of years and saying, he has come up with a solution. These solutions are interesting, but I think in the end, there is some assumptions, at least in some contrived way, there is another 51% in there. And if not, it's still not, the solution might apply to an EVM, but it wouldn't apply to Bitcoin itself, because Bitcoin doesn't have that virtual machine built into it. And this is sort of like what some of the solutions are doing now today, right? They're using Bitcoin to move to an L2, and there really is no finality. It may be taking the DA and putting it right into Bitcoin, and you're trying to borrow the security directly from Bitcoin and saying like your L2 is built right on Bitcoin. But since you're doing an L2 and you're creating like an EVM, and you're bridging Bitcoin into your system, you still have a light client, and the light client, if there's enough money on the line, someone commits to attack, there's no way to prevent it. You're going to lose your money. And then there's guys like Nubit or DA solutions that are popping out that are creating solutions that force you to depend on the security of the DA. And the thesis is that if you are, wherever your roll up is settling is where the DA should be, where the state is settling. So if your state is settling on Bitcoin, then the DA should be on Bitcoin, because otherwise you're creating separate concerns or separate security variables that depend on one or the other, the weakest link. If your DA is the weakest link, then your whole system depends on the DA. If your sidechain is the weakest link and the DA is pretty secure, then it's still the lowest, weakest link is your sidechain. But if both are put together, then at least you can say that the security is dependent just on that side, and you don't have any other external assumptions. So in our view, wherever you're settling that state, if it's a sidechain, the DA should be on that sidechain, like how Ethereum is putting rollups to settle on Ethereum, but then there's EIP 4844 right inside of Ethereum. It's important because if the system rolls back, it's able to validate the DA, and it's able to ensure that the DA is correct as part of the semantic validation of the actual base layer, instead of trusting another validator set doing some DA. And then this is sort of what we're looking like now is you have this green bridge. It has finality, so you can do DA on that side system, and then you can build rollups on top. So your DA is shared with the state settlement. And then you have Rollux as sort of the roll-up layer, the fractal layer. The crypto economic security is you're taking the Bitcoin and using it for ancillary services. Okay, and so you build your layer 2s and layer 3s, and it's a transfer hub from Bitcoin into other chains as well, because you get the really secure light client tied to the ability for you to front run and detect and also react, but also have the dual mechanism of merge mining plus sidechain security, which is the honest majority of all of the validators in the system here. And so you get
what is the difference between Bitcoin and Ethereum such that Ethereum rollups are able to inherit the security from the Ethereum L1, but Bitcoin L2s are not able to inherit the full security of the Bitcoin L1?
Yeah, it's a really good question. The way I'm framing that thought is, why not just bridge to Ethereum, and then like with BitVM, for example, you bridge to Ethereum and then you're using Ethereum's light client security, right? Is that sort of what you're asking there? Instead
You
of
mean from Bitcoin to Ethereum? My question, yeah. I mean, in that case, like Ethereum is kind of like a Bitcoin L2.
Yep. And honestly, I prefer that over just people creating POS sidechains for the sake of creating L2s. But then you lose your moat, right? Because now ETH is your L2, and you're just creating a roll up on ETH with that Bitcoin and bridging that Bitcoin over, right? There are some solutions.
The roll up on ETH would still just inherit the security of ETH. It wouldn't inherit the security of Bitcoin.
Exactly, but it's still better than your new fly-by-night POS chain that you just created and has new validators. In our white paper, we called it established sidechain versus new sidechain. In an established sidechain, there's no game known that if that there was this Bitcoin bridging solution that was going to come out in the future, and if you had enough of your sidechain validators, you'd be able to take all that Bitcoin. Well, a new sidechain, the game is well known, and so if you have VCs behind that, they will know that if you secretly, privately sort of accumulate this stack and you buy up from the market, at some point in the future, if it gets used and there's a lot of Bitcoin, you could easily execute that attack if you want. But Ethereum has definitely very good economic security and enough human subjectivity in there that if an attack was to happen, they would probably roll it back. But whether that's as good as what we're trying to do, we're trying to tie directly into Bitcoin using Bitcoin security. But I would say that using ETH as sort of L2 is also a pretty good idea, if instead of just using the POS side chains, if you know what I mean. There is, I think, Build on Bitcoin, they do have they're following this strategy. Actually, they're doing an ETH L2 roll up, and then they're settling the state in ETH, but then they also are sealing that state using Bitcoin merge mining. And so not only do you have to settle normally as you would settle on ETH, you'd use BitVM to bridge into ETH and then go into Bob, but you would also have to merge mine that whole roll up and prove the state within merge mining and that merge mining proof is needed on ETH L1 to be able to transition the state of the L2. Now, I would say that it's an interesting design, but you don't inherit the security properties of Bitcoin by doing that, because the Bitcoin miners they're not ordering the transactions. They're not sequencing or detecting the order of things. So you can effectively, really it's just I'm not sure what you get from merge mining for sealing, because whoever is doing the ordering, whoever is doing the sequencing is actually creating the security because they're the ones that can trick the light client.
The key to inherit the security from Bitcoin L1 is merge mining, because then the miners act as the sequencer.
You're either right into Bitcoin, and so all the Bitcoin miners are ordering your transactions, and then your security of your sidechain, if you're doing like, some sort of Citria type solution, the security of your solution is dependent on the lost block revenue. So if you are attacking that system in private, you're going to repurpose your hash. You're going to move your hash from Bitcoin into the private fork of Bitcoin to try to attack that system, launching all your ZKproofs on that private fork, trying to trick that private fork for over 500 blocks. And then that 500 blocks is your lost revenue. So if that's 150 or $200 million, that's the cost of your attack, as well as potentially Bitcoin selling off in that meanwhile, because you can detect that the hash moves away. But if you're doing, so that's, it's contrived to assume that Bitcoin might sell off because it is a side chain. Bitcoiners might not care, right? But there's a cost of attack of the lost block rewards. If you use merge mining, then you effectively are moving all of that security back out of into a side chain. And so the cost of attack there is you accumulating the side chain to take over that side chain. And if you're merge mining, you effectively, especially if you solve for finality, you effectively create a dual security layer where you have to 51% attack Bitcoin, but you don't have to lose the block rewards. You would keep your block rewards, but instead the cost is now taking over the side chain. So the difference between doing it right into Bitcoin, which a few projects are trying to do, and I'm disregarding the PoS side chains here, and doing it
when you say right into Bitcoin, you mean merge mine?
No, I'm saying like you put all the DA and your ZKproofs and whatever system settlement right into Bitcoin. So very high cost, and you don't get the DA scale. You don't get to scale up, but it's supposed to be very secure, very stable system. You're building it right into Bitcoin, right? Using the DA of Bitcoin blocks itself, versus merge mining where you'd create a side chain. So the cost analysis would be you lose your block rewards on Bitcoin, which is say $200 million, versus taking over the sidechain. And you also lose the front running capability. If you're going to attack, you're going to launch an attack on Bitcoin, you're going to create a fork, and once that fork is done, you're going to trick the light client that I see a 500 block reorg, and here's the proof. And so if you can show that, then you can effectively negate any challenges on something like BitVM. So when someone says, hey, you're moving 5,000 Bitcoin out, how are you able to do that? Like, it's not happening on Bitcoin. But then the operator says, yeah, it has happened. Look, here's the proof. He creates a fake chain of Bitcoin on the side, and he's able to prove because he's got a longer chain. And the challenger is not able to prove that the real chain is correct. It's really BitVM is really just an independent black box, and it depends on the light client. And in a merge mine solution, you would have to do the same thing, but show that the side chain has a longer chain or shorter chain, not Bitcoin. And so the cost of taking that over would be the lost block rewards of Bitcoin versus the takeover cost of the side chain. And then you also don't have the front running capability. So the sidechain cost would be accumulating enough tokens and then trying to trick that finality, however long it takes for that finality to be taken over, and then going to vanilla merge mining and attacking vanilla merge mining, which is not that expensive, but it takes time. You have to take 51% attack of the Bitcoin hash rate for the length of time needed, if it's 500 blocks or whatnot. Does that make sense?
Yeah. One follow-up. Does it become easier and cheaper to exploit a sidechain as the block rewards go down?
Interesting. Like over time, it depends on the economics of that system. Like if the sidechain has real utility, like real transferable utility and economic utility, then that should be commensurate of the market cap, right? If the sidechain has a lot of Bitcoin in there, then probably people trust it. It probably has utility. You're probably building systems with it. Then the even if you look at Bitcoin, the block rewards go down, the fees are going up, and the fees are going to cover for the difference, right? If the fee model makes it sustainable, then even as the block rewards go down, you still have to you still have to buy up the collateral to launch the validators. The question is more probably, would the value of the token go down if there's no subsidy and the validators don't want to run anymore because there is not enough subsidy? So this is a really good question, and asked in Ethereum Foundation guys as well. Like, you know, how do we ensure long-term viability? And so EIP 1559 was sort of born out of that, was to create the static sort of cost model that keeps paying out validators. It keeps paying out, in our case, these Sentry nodes that don't deflate. But it does deflate once the system is used. You know, if it's really, really busy, a lot of gas is burned, it could become deflationary. But otherwise, there's a static block reward that the validators and the miners keep earning. And that's how we sort of saw that. In our case, the validators are earning, they earn a set amount, and that's deflating over time, but it stops deflating at a set amount. Like I think it's like 5 coins or 10 coins. It just stops deflating and it will just stay there. And so these validators are always going to be paid this block subsidy long term. It's deflating up to like maybe 0.5% inflation per year or something like that, based on the current supply, and then it just stops. And the validators are always going to be paid this amount after that.
And those are the Syscoin validators or the Rollux validators?
Yeah, on the base layer of Syscoin, there it's always going to be paying. And the
those
miners,
are the block rewards that are paid to the Syscoin validators. Okay.
Yeah, and then on the EVM is EP 1559. So the miners are getting this static block reward that's always paying them out. And it may become deflationary, but they're always collecting that block reward based on EIP 1559. So it's like 10.55 coins per block.
Those are Ethereum validators?
No, those are valid. Those are miners, Bitcoin miners mining the Syscoin sidechain, and then the Sentry node validators that are running a full node of the Syscoin client. They are earning rewards right now, and they're going to deflate 5% a year, but it stops deflating after some amount.
Okay.
Yeah.
And
so this,
and just to, please.
You just have incentive for you to be able to run long term and create security for that system, regardless of how much it deflates.
Got it. Because it stops deflating at a certain point.
Yeah, it just stops in just a very minimal amount that keeps going.
Cool. Okay.
Yeah. Otherwise, like you're right. Like, who's going to want to run a full node if the block rewards are gone to zero and the fees may or may not cover, right? And Bitcoin, it's a different story. There is no validators, so it's just the miners that, if someone wants to collect the block fees, they're welcome to. And today we're only 25x lower than the block subsidy. So when Bitcoin goes 10x and potentially a few more roll-ups or systems like this launch, and it adds more demand for block data, that fee subsidy is actually going to be higher than the block subsidy. And so block subsidy, you can think of it as a bootstrap to be able to create a fee market that will overcome the actual block subsidy. And that's interesting because a lot of people push for big blocks, right? But if you push for big blocks, then the block fees go down. And so actually you want to promote self-sustainability. And we think, we're almost there with Bitcoin. That doesn't apply to side chains, especially this, because you need validators to create finality. And for validators, you can't rely on just fees, because if the fee market's going up and down and the validators drop too fast, it can affect the security of the system. So you definitely need to have some sort of subsidy that will keep going long term, where they can depend on it instead of just a fee market.
Yeah, and that's an even more pressing, like more urgent thing to consider than some may realize. Like I was always of the mind, or I was of the mind that, like, this only becomes a problem around the year like 2100 or 2140 when the block reward totally runs out. But that's actually much more. It's actually much more pressing to like make Bitcoin sustainable, because one or two more halvings, and now the block reward is to a point where it may not sustain the network, and so the fees, depending on price, right? So the fee, it is a more urgent thing to. The fees are more urgent to solve in the near term, rather than like let it, like then wait until the 50 years down the line and then solve it.
Yeah, it's funny how, this is all sort of coming to a head around when people are estimating AGI to come. So, it's almost like a bootstrap to get us to the point of no return, and it should be self-sustainable after that. We're almost there. Like, it used to be thousands of X, and the Bitcoin community would say, no, we need to increase subsidy, or we need to increase block size. And no one really, it's great that we didn't do anything, because no one understood all the variables involved. And we're seeing the fees almost there. So it's great to see that. Yeah, so the only other thing I would say about OpCat and stuff like that is, the way I see it, the QED is that sidechains will always be needed, because if we think of scaling up, we'll need DA. And so, as we showed with the diagram here, if you add custom DA layers, you're going to have red bridges to those. Your weakest link is going to be that DA layer. In order for us to maximize the security, so that we can show the Bitcoin community that there is solutions that are very secure, that don't have these weakest links, these chains in the middle that would break under stress, you end up having sidechain wherever the settlement of that system is. If it's a modular stack, it better be modular. If you're creating a monolithic sidechain, it's not very interesting. So if you're creating a modular stack, then the settlement of the rollups should be the same place as where your custom DA is sitting, to have everything enshrined in one base, so that the system is secured in one light client. And that light client matters because the bridge, if you're moving that Bitcoin over to your side, depends on the light client. If you're depending on, multiple layers within the light client, and then one breaks down, then your system is insecure. You can steal that Bitcoin. So having that coupling is really important, the DA plus state. And with OpCat, you're seeing people being able to do ZK rollups or ZK proof systems of Bitcoin off chain, and that's great. And it's also optimizing BitVM solutions, making it cheaper is great as well. The challenges there are, if you go into that and you think, okay, well, will these solutions compete with an EVM? Could you actually do an EVM? And anytime you get into an EVM, you end up doing a side chain, because you're going to represent the Bitcoin in an account-based model. There are solutions that are trying to scale up using OpCat, doing ZK side chains, and those are great, but they'll be using UTXOs, right? So, for example, transitioning, taking an input and spending an output, and then taking the next output, spending it in another, and creating like a chained series of UTXOs. And that's good for like some use cases, like very secure vaults and stuff like that. But you can't do things like Uniswap, AMM. And so you're going to be competing in a market of utility that has all these very cool things that you could do, and all of the Lindy effects of EVM developers and Solidity and all this cool stuff happening, versus, okay, now what does the UTXO side offer? There are some shortcomings of that. There's some great things. You could do parallel computing and stuff, but shortcomings of utility that you'll be competing with. which will push the world back into more of an account-based model. If you just can't do an AMM-based system, everything in DeFi depends on these AMM dexes today. So if you can't do that, developers may not even want to build in that and offer utility. So you go back into a account-based model. And if you go back into an account-based model, OpCat doesn't matter because you have to create this BitVM style bridge into your side system. And so OpCat is not needed for that, right? You can do BitVM without OpCat. So this is why I think that OpCat might be a red herring a little bit. You know, it's not really needed to scale Bitcoin. Yes, it would be cool to do vaults and these sort of things to add utility to BTC, but you can also do those on the virtual machine layer once you have your sidechain. So it ends up resolving all back to a sidechain. And how do you do a proper sidechain? We've presented one here. There's probably, you know, plenty of others that are doing very secure versions as well.
I think that was great, Jack. Thanks. And yeah, it's a fresh new perspective on OpCat and kind of what the result is, you know, once you implement it and sort of the state of things afterwards, as far as the practicality of using Bitcoin on a sidechain that has OpCat and then using one on something like an EVM account model. I think I've exhausted all my questions so during the presentation, so I don't have any more. Yeah, really appreciate you coming on, man. If you do have any closing thoughts, feel free to share. Otherwise, I think it was great.
Yeah, no, I love that. You know, I'm not saying that L2s or POS L2s shouldn't stop doing what they're doing. The fact that the funding is coming in, it's just a function of pressure, effort, funding. You know, all the just like how AI has gotten so, you know, recursively fast is because the funding has been there. So I fully expect a lot of really cool things. And the beauty is that the Bitcoin system is pure, and we're going to be building utility into this pure system, and none of that's priced in. And so I think a lot of things are going to be priced into Bitcoin, and it's looking really good in terms of the where the market is. The ETF got approved on ETH, so it proves that, you know, all those sailors rants about the equity aspect of Ethereum going against it means that that opens the doors for not only ETH but every structure that sort of looks like ETH with subjectivity or any sort of human component to it is going to be accepted in the market, including Bitcoin L2s as well once they grow big enough. So yeah, none of this is really that priced in into the market, and we expect a really bright future. This run should be dominated by utility and bringing responsible utility. You know, the meme coin stuff might be around, but I think it's really coming to a point where we're seeing these solutions emerge that it's going to help the world rather than just create speculative cycles.
That's awesome. Yeah, that is the hope. And hopefully with this institutional adoption, we'll see it. We'll see that capital flowing towards more legitimate use cases and more meaningful use cases than meme coins, as you describe. It's as fun as those are. Jack, again, thanks so much for coming on. Absolute pleasure, man.
Yeah, thanks, guys. Anytime. Glad to be here at your guys' service.